The Indian rupee has been recently making headlines, hitting record lows against the US dollar. If you can see on the chart, the Indian rupee closed at a fresh record low of 83.56 recently. This has raised concerns about the health of the Indian economy. So let's delve deeper into the reasons behind this depreciation and the Reserve Bank of India's response. So what are the reasons for the rupee's decline? The US dollar has been strengthening globally due to the rising interest rates in the US and on the back of the highly anticipated Fed meeting and inflation levels. As you know, higher interest rates in the US make dollar-denominated assets more attractive to investors, leading to a flight of capital away from emerging markets like India. In fact, the strength of the dollar can be assessed through the dollar index, which currently trades at 105.23 levels, indicating a strong dollar. Additionally, foreign institutional investors were net sellers in the stock markets, selling over 40,000 crores in the last 3 months. This led to a further pressure on the Indian rupee. Furthermore, despite easing political uncertainty, the rupee is expected to be under pressure in the short term because of renewed demand for dollars, leading to increased hedging activities by importers and exporters, putting downward pressure on the rupee. India is a major oil importer and in fact the second largest importer of crude oil in the world. The recent surge in oil prices has put a strain on the country's foreign exchange reserves. And since crude oil is traded in dollars, it increases demand for dollars to pay for oil imports, thereby weakening the rupee. And to prevent the rupee from falling lower, the Reserve Bank of India intervened in the non-deliverable forwards market to stop the rupee from depreciating lower. In context, the RBI usually intervenes in the forex market to support the depreciation of the rupee. The RBI resorts to open market operations in the form of buying or selling dollars to influence the rupee, and the second is by altering the interest rate to cater to the inflow and outflow of rupee. Another point to highlight is the inclusion of the Indian government bonds from June 2024 in JP Morgan's emerging market debt index, which could result in inflows of close to 23 billion over the next 10 months. All in all, the rupee's record lows presents both challenges and opportunities for the Indian economy. A weaker rupee can make imports costlier and potentially fuel inflation, but on the other hand, it can make Indian exports more competitive in the global market. The RBI's intervention can provide temporary stability, but long-term solutions to strengthen the Indian economy are needed to ensure sustained stability. Having said that, this is me, Rahalasan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.